Good afternoon, ladies and gentlemen. It is July 15th of 2022. My name is Robert Rayburn here at LifePro Asset Management, and this is CPI week, in other words, inflation week. We had that inflation report that everyone was super scared of. We saw a lot of heavy selling into the report on Wednesday, and then really after Wednesday, it was a whole different week. We saw markets generally rebound, and then on Friday, growth names took the charge, which is very bizarre when you think about it. When inflation rises, that's the kryptonite for the kind of names that we invest in. And if you remember what we've been talking about the last 4 to 6 weeks, it's that June was a very strong month as it relates to price pressures, but that in mid-June, those price pressures, the actual day-to-day prices, rate of change prices, whether it's oil or commodities in general, freight rates, those things started to roll over really hard. But the report is backward looking in June. So we're going to go through all of that and why, in general, asset prices reacted quite well to a very bearish CPI report. So the title of this week's presentation is the inflation head fake. In other words, a high inflation number, but then assets that don't react well to inflation rallied. That doesn't really make any sense, does it? So we're going to go through why that happened. Are there any clues from the inflationary inputs that we generally see and track? And then lastly, what works in this type of environment where you might get the inflation head fakes, where suddenly market might be looking through those numbers, and based on what we're seeing from those inputs, what do we want to buy and own in the portfolio? So as it relates to this week's pullback, most of it was related to selling ahead of the inflation report. We had a strong rebound since really mid-May. This was really the first week since, I would say, the second or third week of June, where we had a pullback in asset prices on a weekly basis. And most of that tied to the fear going into the inflation report. The good news is, since the inflation report, things have rebounded strongly. Not enough to offset the Monday to Wednesday weakness, but certainly resuming trend, as we would call it. We had some headlines out of China as related to data breaches and fines related to prior merger and acquisition deals that weren't disclosed to regulators way back in 2011. The reality is that a lot of Chinese stocks have rallied quite strongly since March, and this was just a classic, easy excuse to take a little bit of money off the table. We think the long-term trend is in track. These names are dirt cheap. They're growing strongly, good free cash flow, and certainly as President Xi enters a new term in office in the fall, he doesn't want to disrupt that economy. Lastly, alternative energy names. We saw a really big sell-off here on Friday morning when it became clear that the Build Back Better bill is going to fail without Joe Manchin's support. A lot of these solar names were down 8 to 10%. And if you did that, you left 10% on the table because most of these names had very strong reversals throughout the day. Solar remains in a long-term secular growth trend. We love the space. The economics make total sense, has nothing to do with left-wing or right-wing politics. The technology from a cost perspective is really beginning to make a lot of sense at scale. Lastly, that software weakness. We saw ServiceNow comments, the Unity acquisition. Both of these rather transitory as it relates to trading conditions. ServiceNow comments, we believe, were mostly related not to ServiceNow, to their competition. Specifically in Europe. And everyone knows that Europe is weak. That's why we're not really invested in Europe. But their American business continues to click along nicely. So we're not too concerned there. We did lighten up a little bit just because we needed the money for our biotech weight. But aside from that, no real big concerns there. So inflation. This is the CPI report, a strong reacceleration, an inflationary acceleration in June. But this is the key, ladies and gentlemen. In June. What month are we in? We're in July. And what do markets look at? August, September, October, November. They don't care what happened in June. It's already happened. So yes, we saw an acceleration in June, but the idea of selling stocks and bonds and buying commodities turned out to be the exact opposite, where we should have bought stocks, should have bought bonds, and sold commodities. And a lot of this related to where that inflation is coming from. It's mostly, we can see here the chart on the left, it's coming from the travel names. And the problem is that travel names are likely peaking out here in terms of their business. A lot of these stocks are actually breaking toward 52-week lows. Even though you go to the airports, the lines are out the door, you can't get airline reservations, you can't get hotel reservations, but here's the key. Stocks trade based on rate of change. And right now, it appears that travel names are reaching a peak on a rate of change basis. So when those rate of change numbers start to roll over, in other words, it's as good as it gets right now, people sell ahead of that. So that's really the big reason that we saw a positive reaction to that overall CPI report. But there's a few bigger reasons. One is when we look at what the market's looking for ahead of June, into July, into August, into September and beyond. We look at what are called one-year inflation swaps. In other words, bond investors, what do they think inflation is going to do over the next year? And they make a bet on that. They may say, hey, I think inflation is going up, so I want to buy inflation swaps, or I think that it's going down and I want to short those inflation swaps. What have we seen here? One-year inflation swaps have gone, as on core CPI there, has gone from 6%, and this was in June. Remember, that's the key month here, June. It's gone from 6% in June all the way down to 3.5% today. And this is post-CPI. Remember, this is post-CPI. So we've gone from 6% to 3.5%. And this is in the span of a month. So what gives? Why would people think that inflation is collapsing when we just had a report saying it hit a new 30-year high? What gives? Well, let's look at the inputs, ladies and gentlemen. Oil prices. Notice what happened. A peak. What month? June. It peaked just over $120 a barrel. Where is it today? $96 a barrel. What is that? That's a 21% decline. So since hitting a June high, we've had a bear market develop in the price of oil. So what does that mean for your wallet? Let's take a look. Gasoline at the pump, a June peak. Remember, that's the key month, June. You're going to continue to hear that month. We saw over $5 a gallon, all the way down to $4.60 a gallon. A lot of work to do. I don't want to pay $4.60 a gallon, but that's far better than $5.03 a gallon. So gasoline prices help the consumer and will help bring down headline inflation. And it's a big component of CPI, as we can see here on the chart on the left. Motor fuel is over 2.3% of the overall 8% number and above that we saw with CPI. Where are gasoline prices going to go in the future? So one of the things we look at is not just oil prices or gasoline prices today, but what are gasoline futures doing? So gasoline at the pump down 8% from its peak. What are gasoline futures doing? Gasoline futures are down 28%, while WTI oil futures are down 31%. So we think there's going to be a convergence between this down 8% on gasoline prices and what the futures market is indicating. If we continue to see that, that should feed into further disinflation at the pump. What about copper? Copper is a huge infrastructure and industrial input cost. All those heavy machineries, a lot of copper that goes into those machines, right? Infrastructure, rail, all that kind of stuff feeds, copper feeds into that. What we've seen here is a 35% collapse in the price of copper since, this has really actually happened since March, but notice what happened. In May, it rebounded into June, and on June 1st, it all started to collapse again, right? So again, June is again a key month. A discount at Starbucks? I grab a coffee every single day before I get into the office, and I think there was 4 price increases I noticed over the last 4 months. Guess what's happened to coffee futures? Coffee futures are now down 23% from their peak. Let's look at cotton. Most people's clothes are made out of cotton. The cost of clothing should also drop dramatically. We've seen a 42% collapse in the price of cotton. Again, similar, big peak here in the month of April. We declined, rebounded into June, And look what happened in June. This is what happened in June. A straight off the cliff collapse in the price of cotton. So the theme this week is the disinflationary trade appears to be taking shape. Yes, there was some heavy selling on Monday and Tuesday and Wednesday of this week. A lot of that was the fear ahead of the inflation report. We saw strong action on Friday and a recovery on Thursday. That's the key. So that when we look at that disinflationary trade and we look at the fact since May, even though the market hit new lows, a lot of the growth stocks that we're looking at, if we look at our opportunity portfolio, for example, very strong rebounds off those lows, even though we did pull back this week. So from a historical standpoint, what are the sort of assets that outperform during disinflation? Growth stocks tend to outperform value stocks by quite a bit. Number two, you want to go further out the duration curve as it relates to bonds. In other words, instead of owning a 2-year bond, own a 10-year bond. Why? Because that interest rate risk is coming down and you're going to get price increases on the long end of the curve if disinflation indeed takes place. And then also, lastly, high yield tends to outperform investment grade bonds. Why? Because if interest rates come down, that's much better from a rate of change perspective for firms that have low credit quality. High yield bonds have lower credit quality than investment grade bonds. That's what we want to consider. And lastly, it's not on this chart, but if you are looking for some sort of lifetime income solution as it relates to an annuity or something like that, now's the time where you kind of lock in those rates, because we think that rates are actually going to likely come down over the next 12 months. Again, not a guarantee, but when we look at these disinflationary trends, now might be a peak time for annuity rates. So definitely, if that's something you're looking at, we don't, on the investment side here at LifePro, don't recommend, or I shouldn't say don't recommend, but don't look into annuities. That's on our fixed side of the business, but something to consider certainly. So that's what we got for you this week. Have an absolutely fantastic weekend. And if you have any questions or concerns, please feel free to reach out to us at 888-543-3776. Thank you again and have a great weekend.